Good morning, everybody. Welcome to Windsor Brokers Live Daily Market Outlook for Thursday, 21st of February 2013. I do apologize for yesterday's mistake. I've been heavily criticized by a number of people asking me in which year do you live. I have the calendar, I have the clock with the date and time in front of me, and I see the date, but unfortunately many times I make this mistake moving back to the previous year. However, a lot to talk today following yesterday's strong market action with a lot of movements seen. We are going to briefly take a look on the reasons why this happened. Most of us already know what were the main reasons. However, we are going to elaborate it more, and of course a very busy calendar. Today we're going to take a look at the calendar. Today's, I would call it PMI day. We have a number of PMIs to be released, and these are the top highlights from Eurozone as well as United States, among the other economic indicators that are due to be released today. Definitely the dollar was the top performer yesterday and displayed the outstanding performance as FOMC minutes from the January meeting now open a dangerous can, I would say, signaling that several members of FOMC asked for a possible downward revision of the amount of bond purchased by Federal Reserve, so-called quantitative easing, and the Fed should be prepared to vary the pace of its 85 billion US dollars per month quantitative easing program. This was basically, there was still a widespread debate over the United States economy being able to pick up enough momentum so that the Fed can end eventually the asset purchases towards the end of 2013 and the beginning of 2014. Still a significant improvement in the jobs sector, which is the most painful thing in the current attempts of recovery of the U.S. economy, is required basically to give a firmer signal of a possible easing or completely stopping, reducing the speed or stopping the quantitative easing program. The chances of ending asset purchases before the outlook for the labor market improves substantially now are strongly higher, and this is one of the main reasons why the investors jumped yesterday heavily into dollar. That pushed a number of its counterparts through some significant support levels as euro slumped below its recent range floor and the base at 133. Sterling made a major bearish breakout. The only one that stayed quite unaffected was dollar yen, as it still holds its 100 pips range between 93 and 94, while dollar Swiss again regained the ground on after finding a support at 91.82. I think it's just below the 92 base, and tested our initial target that we mentioned yesterday at 93.00. Top losers were commodities yesterday, crude oil and gold. The spark for the fresh slump in the prices was the first of all rumor that circulated through the markets that a big hedge fund was forced to liquidate substantial commodity positions. That triggered a sharp sell-off of initially crude oil and then gold, as crude oil dipped below its base at 95.00. Also, another pressuring point was the comments we mentioned yesterday of increase of Saudi Arabia's oil output, as well as Iran talks that are eyed all the time, and this is the thing that continuously affect the oil price. Significant losses of crude oil are now threatening the downside, as we said the price broke below its near-term base at 95.00 and signaling a possible major reversal of its recent peaks at 98.22 and 98.63. We're going to elaborate this more in the technical part. There are some signals for possible reversal, while gold suffered substantial losses as yesterday's break below 1600 and closed below this level, as psychological support now opens way towards critical support at 15-20-30 zone, seen as a break point for some major corrective action. Reminder, yellow metal slipped as low as 15.55. This is one of the interim supports. We had one at 15.6. First one was Fibonacci expansion at 15.82, and then 15.63 and then 15.50, threatening seriously the attack at 15-20-30 critical support and the break point zone. These are the major highlights for yesterday's price action, and now today I would say we can expect some consolidation of the current of the recent movements. Most of them were negative. If we take out the dollar, all the other counterparts suffered heavy losses, and some consolidative rather than corrective action could be seen as a number of instruments have confirmed or established fresh trends, and this especially addresses the sterling that shows the major breakout of the multi-year range floor that is opening way for a fresh bearish phase and possible extension to initial supports 151 and 150. Again, more of all this will come in the technical part. Meantime, you can prepare your questions if there is anything that we missed in this fundamental and the news part, and then we're going to take a look at today's calendar to see the releases that are coming. Trade balance from Switzerland already released at 7 o'clock GMT. Improvement, further widening of the trade surplus to 2.13 billion Swiss francs in January compared to February's 900 billion, and forecast of increase to 1.74 billion Swiss francs. Manufacturing and services PMIs from Germany and Eurozone are due at 8:30 Germany and 9 o'clock GMT Eurozone. Both are forecasted in a more optimistic way. We're focusing on the manufacturing PMIs that are more significant at this point. German one for February is forecasted at 50.4 versus 49.8%, 49.8 in January. The most significant basically thing is that forecast is above the 50 break point, which divides contraction from the growth. Services PMI is seen slightly dipping in February, 55.5 compared to 55.7 in month of January. Eurozone manufacturing PMI for February is forecasted at 48.4, showing that whole Eurozone economy is still in the contraction, still not able to break the threshold at 50 level, but forecast is better than the January's release that was 47.9. Conversely, the services PMI for Eurozone is expected, according to the forecast, to show improvement, as today's consensus is 49.2 compared to 48.6 in a month of January, different from the German one that is seen contracting according to the forecast. Public sector net borrowing for January PSNB from UK is due at 9:30 GMT, and the negative forecast of minus 11.3 billion is seen today compared to 13.2 billion seen in the month of December 2013. CBI industrial order expectations from UK due at 11 GMT, minus 16 forecast compared to minus 20 in January. And then we have data from the United States, quite important releases, as most of them are in red color. That gives the highest importance. Unemployment claims due at standard time, 13:30 GMT. Again, jump compared to the previous quite positive dip to 341,000. 361 is for the previous week forecast, showing that new jobless claims are added during the past week. U.S. inflation for January monthly is expected, the core one is expected to tick to 0.2% in January compared to 0.1% in the December's release, while monthly inflation is forecasted at 0.1% compared to flat one in December. Manufacturing PMI from United States due at 1400 GMT for February is again seen lower than the January's 55.8. 55.6 is the forecast, with the Philadelphia Fed manufacturing index for February showing, according to the forecast, improvement by 0.7 to 0.7 versus the contraction of minus 5.8 seen in the month of January. Existing home sales at the same time, 1500 GMT, are seen at 4.91 million new houses, new units sold, compared to 4.94 in December 2012, slight contraction seen according to today's forecast. And then we have natural gas storage and the crude oil inventories that have been moved from yesterday due to the holiday, President's Day on Monday. Another build of the crude stocks is forecasted for the past week by 1.9 million barrels compared to the build of 0.6 million barrels in the previous week. And the FOMC member Ballard is due to have a speech at 17:30 GMT, and that's all from for today's calendar. Quite busy. Thursday is usually very busy with the economic indicators. Our focus comes that are quite to be released quite soon. German PMIs and then Eurozone PMIs, as well as PSNB from UK, and a bunch of data from United States are the main focus today. And that's all from the fundamentals and the news. Let's take a look at the markets. Quite interesting situation in the number of instruments today, and see what are the expectations for the major currencies and commodities in today's price action. As said, the euro lost ground. You still don't see the euro chart, or it's my system that is not showing. For some reason you are not. I think you are supposed to see. Can someone just confirm that you see the chart on your screen, please? Because my control screen shows still a calendar. Okay, you see the chart. Thank you very much. Okay, starting with euro. Basically, yesterday's corrective action of the recent base at 133.00, break above the 134 that marked the near-term range consolidation. The top, we're talking about levels here, did not produce much of the recovery, as the price stalled at 134.33 ahead of 134.37. That was the, wow, we don't see it here. That was the Fibonacci retracement level. We have to draw it again in order to see. I think this was the one. If I'm not mistaken, it is wrong. Approximately here. We had a target, if you remember yesterday, we mentioned around 134.40 was the 50% of the down leg from 135.76 to the previous low at 133.05. Failure to break this level produced an hourly double top shown here, and then fresh reversal. First cleared the 134.00 with acceleration seen on a break below 133 base, extending losses as low as 132.35. Now the most significant thing is that we have lost the initial trendline support. This is the first one, drawn from 126.60. That was at 132.85 approximately, and Fibonacci support 38.2% at 133 zone, along with the range support range floor. Now break below these levels, reached so far 132.35, just ahead of the main bull trend line drawn of 120.42 low. I think we can see it on the weekly chart. This is the line from this is the main bull trend line that comes now under a serious threat as the price approached this level just a few ticks ahead of line, which is at 132, approximately 132.30. And then we have another very significant support. 131.85 is the 50% retracement of the entire rally from 126.60 to 137.10. As well as that is seen on the weekly chart, the previous double top of September 2012 at 131.70. Basically, this is seen as a break point that will confirm the major reversal of the euro dollar and confirm the top at 137.10. Now, the break of 132.30 main bull trend line is seen as initial trigger for some for further extension lower, but from the other side, overextended conditions on the hourly chart suggest that some consolidation rather than correction, I would say, at this point, as the bears are now firmly in play, as showed on the lower time frame chart, showing that bears are controlling the situation at this point, and consolidation that so far peaked at 132.75. It's just ahead of our initial resistance, previous support at previous strong support at 133.00. Not much to be expected on the upside. 133.00, and the Fibonacci retracement levels of the yesterday's fall from 134.33 to the low at 132.35. We have yesterday's intraday high at 132.90 along with 133. That is approximately 38.2%, which is at 133.11. And more significant at this point are the previous lows of 18th and 19th of February at approximately 133.20-30 zone. That also marks 50% of yesterday's fall, reinforced by descending 55 days exponential moving average. And at this point, only break above this level would provide a near-term relief and avert immediate downside risk of sliding below the previously mentioned main bull trend line. But as I said, the overall negative tone that dominates, especially the 4-hour indicators that still show enough room for a further extension lower, suggests that possible bearish extension is quite a likely scenario. Supporting the notion is the reversal of the daily indicators that are now breaking below their midlines. The momentum is already below, while MACD is now attempting, RSI is pointing lower. We lost the 55 days moving average at 132.75. That was reinforcing the shorter bull trend line of 126.60, giving overall picture quite negative, giving to overall picture quite a negative tone and seeing increased risk towards the downside. As said, 133 initial resistance, anything above 133.30 could produce some stronger corrective action and avert immediate downside risk. Otherwise, we are still at risk of breaking below trendline support at 132.30 and then testing a break point at 131.85 or 131.70. One of the top losers, pardon, I opened the wrong one. One of the top losers was the British pound, as we predicted yesterday. I usually go after a couple of hours to see my comments distributed in the written analysis, whether we are reaching the target or we are missing completely analysis. In the past couple of sessions, we were 100% correct, especially with the sterling. I predicted the test of very strong support. That was more or less expected. Multi-year base of the range that has been established since 2010. The lowest point was 152.33, low of January 2012. Yesterday's sharp acceleration lower, that was basically triggered by break of the main bull trend line. We have to go to the monthly chart to show it. Bull trend line of 135.01, low of 2009. That was cleared a couple of days ago. It was around the 157, showed a strong acceleration lower and showing the heavy weekly losses last time seen The heaviest one was in January, and then the previous ones we have back in May 2012. Heaviest weekly losses since then, breaking below 152.33 and the 152.00 is psychological support, extending so far to 151.30, ahead of our next downside target, which is Fibonacci expansion of the extended wave from 163.80 that stands at approximately 151, 150.98 is exact level. This increases also risk as the break below this level signals that the market is now looking for the major bearish breakout, as we were entrenched within the range since 2010, and the downside was well protected at these levels. Now major bearish breakout signals that further extension lower is seen as a quite likely scenario. Now we have to move to the monthly chart. Another bearish signal was seen on the break below the monthly Ichimoku cloud base that coincides with the previous low at 152.67. So another bearish signal, a strong bearish signal, given that possibility of further extension lower is quite likely. As said, we have initial target at 151.00 that we are not very far from 261.8% Fibonacci expansion. Then focus, I wouldn't speculate further, but near-term focus would definitely go to psychological strong support at 150.00. Of course, we should consider also the extension lower, as break below these levels would be signal for a possible test of next significant static supports. 143.44 is June 2010 low, and then May 2010 low at this is very significant higher low at 142.30, expected to come in the near term. Focus in case of extension and acceleration below 151 and the more significant 150.00. Back to the near term charts, overextended conditions on hourly and the 4-hour chart suggest that some at least consolidative action should be seen. 153.00 is, pardon, 152.00 is offering initial resistance. I have them written in front of me, so I'll tell you exactly. 152, 152.50 zone seen. We can take the Fibonacci levels of yesterday's slide, and we have 152 as 23.6% and 152.50 is 38.2%. However, any significant break higher requires any significant extension. Higher breaks requires break above approximately 152.90. That is 50% retracement of yesterday's fall, and then 153.25, 61.8%. Where the market around these levels, in case of a stronger recovery, may face stronger resistances at these points. This is also reinforced by descending hourly 55 days exponential moving average, and we see the break above 153, 153.25 as a trigger for some stronger corrective action, and it might delay initial bearish scenario of possible extension through 151 towards 150.00. The instrument that was the least affected from yesterday's movements, yesterday's strong movements in the market, was dollar yen. As we can see, it's still the patient is hardly alive, and his heartbeat is showing a range of 200 pips, with the narrowed pips in past couple of sessions seen between 93 and 94.00. Yesterday's upside rejection was seen at 94.02, while downside is still well protected at 93 zone. Rather neutral tone seen on both lower time frames, 1 and 4 hour charts. Doesn't show any direction at this point, but more significant is a loss of traction on the daily chart as indicators. Now RSI is already out of the oversold, overbought territory. MACD is pointing lower. Momentum is lower. The stochastic already moved towards the downside, increasing possibilities for a possible stronger corrective action. Of course, break below the base at 92.00 seen as the initial signal and initial trigger that would confirmed that the pair is in the bearish action, in the corrective action of its a larger rally from 70, pardon, from, let's be precise, 77.42. This is the low of September 2012, with the Fibonacci levels of the entire rally coming as follows. We are quite far from this. I guess we should take some lower smaller move in order to see it more clearly from let's say in 86.81, which is the low of 9th of January 2013, because this is basically the pardon, 2013 rally. 92 is between 23 and 38.2% retracement, break of which will face immediate 38.2% at 91.53, with another significant barrier at 90.63, 50% retracement, along with 90.23 previous highs. However, not to speculate more, the basics show requirement of a break below 92.00 range floor in order to trigger some stronger corrective action, or resumption of the uptrend on a break through 94.45. That will open 95.00 2010 high. So far, negative tone does not show any direction in the near term, but again, indication of possible bearish resumption is seen on the descending daily studies, but still needs requirement on a break below 92.00 base. And from the currencies, dollar Swiss congestion between 92 and 92.50 did not produce positive result, as yesterday's brief break above these levels reached 92.56 and then reversed down below 92.00. That was initial threat. In yesterday's comments, I mentioned that more risk was seen towards the downside as we lost initial support in the higher platform at 92.00, but luckily the pair found support at 91.82, and since then started a steady recovery that accelerated basically on a break above the range resistance, and tested initially 93.00. A brief corrective action was seen overnight down to 92.73, and now we are facing again the fresh rally through 93.00. 93 is also the daily Ichimoku cloud top, and also marks 76.4% retracement of the entire down leg from 93.87 to 90.20. Now this signals stronger recovery and a possible test of our key barriers and the break points in the near term at 93.81, peak of 7th of December 2012, and the 18th of January 2013 high at 93.87, a break of which is seen as a trigger for some stronger corrective action. As on the weekly chart, we can see that basing attempt now is evident on the at 90.20, as weekly 90 days moving average mainly contained the recent weakness of July 2012 peak at 99.70, and now break above levels at 93.87, 93.81 is required to confirm and signal stronger recovery that would prevent further retracement of the larger rally from 2011 low at 70.67 up to 99.70 peak of 2012. As said, overnight session low at 92.73 offers initial support ahead of a 92.50 zone that is seen as the next significant one. In any case, any dips lower should be ideally contained somewhere around the 92.50 zone, but any extension lower down towards 92 with reversal at or above this level would not be that harmful for the immediate bulls. As we can see, this fresh strength is now underway, and most likely scenario will be fresh strength of the US dollar and the possible test of our barriers at 93.87 and 93.81. Crude oil suffered quite significant losses yesterday. We can see on hourly and for our ADX, that bears now came fully in control as the price finally broke initially broke below the channel support at 96.45, and then more significant 95 base established at the end of January. Nearly 3 weeks range has been broken now as the price extended as low as 93.64, just ahead of 38.2% Fibonacci retracement of the entire rally from 85.20 to 98.63, signaling that some more significant corrective action could be ahead of us. 93.50, as said, is acting as a strong support. This is also the previous low of 16th of January, and is reinforced by ascending 55 days moving average currently at 93.22. This extension this reversal could extend down towards 92 zone, where is the important 50% retracement of the 85.20, 98.63 rally, and basically this is seen as a trigger for some deeper reversal that will confirm the near-term top at near-term double top. Actually, this is already initial signal was given of double top on a break below this neckline, and now further extension lower, 93.50, 93.00 seen as the next downside target ahead of 92.00. That marks 50% retracement. Daily studies are building up bearish momentum, and the MACD is about to break that supports the idea of further extension, while 4-hour indicators are still pointing lower despite being in the oversold territory, while similar situation seen on the hourly, despite being extremely oversold, still no signals of reversal as the fresh extension lower commences at the beginning of European session, and seeing now main trigger has been pulled already on the break below 95, so we can expect some further reversal and a major correction of the larger 85 20 98 63 rally. On the larger picture, this is seen as a risk of a lower top at 98.63 compared to the previous one at 100.72. Of course, this we're talking about short to medium term trading with the loss of the near-term base at 84.05. This is the low of November 2012. We're talking about a larger picture. We are in the weekly to confirm the weekly failure swing, and that will be signal for some stronger losses of the crude oil. Of course, we are still far from these levels, but focus is now seen on the downside firmly as we lost 95 base, and we can expect a soon test of 93.50 and 93.00 as our initial targets. On the upside, 95.00 now acts as initial resistance, and the only clear break above this level would delay immediate bears. And finally, our top performer and top loser for yesterday, the yellow metal. As we predicted, the overall negative tone that was established on a loss of 1600 that occurred yesterday, day before yesterday, and yesterday's close below this level triggered yesterday's fresh acceleration through 1600, dipped as low as 1558 this morning. We had a fresh extension down to approximately 1552. That is threatening a test of our key support and the critical support. I'm trying to find this chart. Well, we don't have it. Okay, there it is. 15, 20, 30 zone. It's a critical support. This is congestion, and the platform established since 2011 and held the current in past 2 years consolidation after the yellow metal hit record high at 1920 in September 2011. Basically, we were within the range of 1520 and 1800, and now the structure has lost its initial momentum, and approaching this critical support, and this is seen as a break point any penetration through this level and through 1500 as psychological support will be seen as a signal for a major corrective action of the larger over 10 years uptrend from approximately levels below $300 per ounce to close to $2,000 per ounce that yellow metal gained within the past 10 years trading. All indicators on the larger pictures, larger time frames are bearish, and the bearish assumption is seen as a quite likely scenario. On the daily, we have another bearish moment that is developing now, the formation of that cross as the 55 days moving average is approaching and attempting to cross below 200 days one, currently at 1664. That will be additional pressure to the pair. Now, overextended conditions even on the daily and oversold conditions might see some hesitation on approach to critical support at 15, 20, 30 zone, with some corrective action seen quite likely at this stage. We have the previous low at approximately 1600 as psychological level, and previous support now acting as resistance, seen as initial resistance ahead of 1625, a previous low of January. This is the 4th of January low, and basically these levels are likely going to contain the current possible bounces higher, with the focus still kept on the downside. Of course, the overextended conditions, as we can see, the hourlies are extremely stretched. RSI is already pointing higher. On the 4-hour, it's a similar situation. Initial signals of reversal are given still to be confirmed, and we can look for the less to watch on the Fibonacci 16. Around 16 is the 38.2% retracement, then 1620 is the 50% retracement, reinforced by descending 55 days exponential moving average. And basically, if we see the break above 1620, 1625, also previous low, that could delay immediate bears for some stronger corrective action. Then we have 1635 and 1655. These are also previous lows, and 76.8%, 76.4%, pardon, retracement, break of which is going to signal that immediate danger of testing critical support will be averted. That's all from my side for today. I think we have already some questions sent, so let me just view them and see if we can answer immediately. Meantime, you can type and prepare and type your questions. This is a good question. How we make our money trading from this chart? Technical analysis itself is quite useful study, and if you follow the rules strictly, you can succeed. I prefer, like many technical traders, I prefer technicals rather than fundamentals. Yesterday, let's say if we take just look at yesterday's fundamentals and news that came, first of all, this hedge fund that was rumored as selling heavily commodities, and then Fed's action. We have already seen this. If you just recall the yesterday's comments, what I said for example, for the gold, I already saw it bearish. So the Fed came just an acceleration, but technicals already gave strong signals that bears are in play, and we should be looking for the downside targets. Similar situation with the sterling. It's been 1 week that I mentioned that bearish breakout of the sterling sees potential for more significant extension lower. Yesterday's Bank of England minutes and the monetary policy comments just came as confirmation. I see it as many of my colleagues, technical analysts and traders, see the technicals as very useful, and the main thing that could help you to make money. Of course, you have to be well, I would say, educated, to have good knowledge in using technical analysis, and of course the main thing is the discipline in trading. That requires the whole session not only one, several sessions, how to create and implement rules and follow the rules, which is the most important in order to profit. I again suggest in our website you can find the whole technical analysis studies and like as video clips that you can choose levels, beginner, advanced, and the professionals, and you can learn quite a lot there. Of course, I can assist you at any time. How I can only hit and not give the trade calls? You're meaning the trading advice, market entry and exit points. This is a more technical problem. We are not licensed to do this. We have the company that does it for us. You can find their analysis on our website. And that's why I'm not saying directly go and buy here and buy there, but I think I give you the clear picture what to do. This is my aim. I'm not saying what to do, but if you compare my comments and the comments in the website where the trading signals were given, you will not find I don't think any difference in this. So it's just a technical issue rather than anything else. Yeah, I cannot tell you directly go and buy at this level, sell at this level, but I give you all the directions, indications, and the levels that are important, and it's up to you just to make decision. Again, repeating, if you are not 100% sure, you can go to our website and find the technical analysis part where all the levels and the directions with stops are given. Meantime, just to tell you, I have a number of clients calling me on a daily basis, and again, I'm not supposed to tell them what to do, but I give them picture like I do on the presentation, and they pick it. I mean, there is no problem. Okay, any further questions, or we should conclude? I think it was quite long today. Okay, we had a lot. Euro dollar breaking down the major trend line. We're going to take a look now. Wow, it seems, yes. Yeah, you're right, 100%. It's already cracked. We are already below this trend line. I think you can see the chart. Why you don't see it? Okay, yes, we are attacking now the main bull trend line, 131.96. We are already below 132. So now we are at the break point, 131.85 and 131.70. These two levels, we can highlight it. It's around here. If it goes below this, this will be the major signal for the major reversal of the single currency of its how many months since July until now, from July 2012, 2042, we have the 50, this is the 50% of the smaller rally from 126.60 November 2012 low to 137.10. 50% is seen as a trigger, and then we can look for 61.8 at 130.61, and the 130.00 is very significant. We have the double bottom of January 2012, another significant, but watch initially for this 131.85, 131.70 as initial break point as shown on the daily chart. Since no more questions, thank you guys, everyone, for being with us today. We had a lot to speak. Basically, I like when the market is busy, then we have a lot to talk. Otherwise, if there is no action, like on dollar yen, then you have to invent and say something when there is nothing exactly to be said. I expect to see you again tomorrow morning at the same time. It's the last day of the week tomorrow, so again, I think we're going to see some action in the market today, and we'll have enough subjects for tomorrow. Until then, I wish you a nice Thursday. Keep an eye on the markets as volatility is quite high and the markets are quite active. Of course, a number of economic indicators releases are ahead of us. That would be additional drivers for the markets. Until tomorrow, I wish you a nice Thursday, and of course very profitable trading. Good luck.